People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello and welcome once again to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us, of course, as always, at zinniawealth.com, Zinnia wealth.com. And we're glad you found our podcast. We're glad you found our radio show. And the reason that we are here is to talk about you and your retirement. We talk about money here on this show, which is one of those topics that you're not supposed to talk about. But we do. All right. How are you doing today, Charisse?
I am doing great. I'm doing extra great, actually. I was among my wolf pack for a couple of days, and
what is
I'm feeling great.
I don't know what that is. What are you talking about? What is your wolf pack?
So I call a wolf pack. So it's people that are like-minded thinkers and doers and entrepreneurs, and not every entrepreneur is part of my wolf pack, right? And everybody has their own pack that you hang with. So I went to the John Maxwell High Capacity Leadership Program, and I was asked to come to that. It was their very first one they've ever done. And he's done lots of other things. But this one was, Charisse, you need to come. Don't miss it.
Okay.
So I went, didn't really know what I was going to be doing. I've never done a leadership program ever in my life, but I've always wanted to. Like 20 years ago, I'm like, yeah, I want to do Tony Robbins. And I even wanted to do John Maxwell back then. And there's so many more today. I just haven't. You know, you get so busy, you have kids, you put things off, you procrastinate, right? And so finally, I had an accountability partner and I went. And it was truly amazing. And, you know, I feel like I'm a good leader, but I really want to go from good to great. And I think through this program, that will certainly help. And John Maxwell's one of his biggest things is that you're going to meet people you could never meet on your own. And he said he's in his fourth quarter of his life and he wants to give it all away, like from his money to his values, to pour it into people. And he's looking for, you know, a few people to do that. And so I will definitely be one of them. And so it was very fun. I was even put to the test. I got on a horse, Randy. And
now I
know that sounds funny.
You own horses, but you don't ride horses. Am I right?
Yeah. It's one thing people don't know.
All right.
So I think it's been almost 20 years since I've been on a horse.
Okay.
And I had a barely green broke or something like that. Horse, green ground horse, whatever you call it. I'm horrible with the terminology. And I own horses. And I just wasn't having a great experience. So I haven't got on a horse. My sister rides horses every day. She competes. My kids get on horses all the time. And so they did a surprise experience while we were there. And we went out to a ranch in Austin, Texas. And I'm like, oh, this is great. And they're like, okay, you're going to get on horses now. I'm like, oh, gosh. And you have to do it, right? This is the leadership program. You're leading the horse. Not only did I have to get on this horse, they gave me the most stubborn horse, right? So I'm with a group of 5. My horse was the only horse that was going to the right. And I'm like, hello, my horse will not listen to me. I'm pulling the reins. I'm doing what I'm supposed to do. And the horse would not listen. I'm like, this horse was made for me. It was putting me to the test. I know John was like, give her the toughest one. Being from Ocala horse country, you think I would do better. Anyways, what I had learned, there was coincidentally, there was a lady named Nikki from Tampa, amazing woman, big leader, empowerment with women, etc. And so I got to know her, and she happened to be in front of me, and she rode horses, and she's sitting there with her hand on her hip, and I'm like, how is she doing that? She's so comfortable, and she's like, just relax. Tell the horse what to do. Lead the horse. So we were like going down massive hills, up hills. We were going across streams, like with these big rocks. I'm like, oh my gosh, this horse almost almost chopped off my leg on a tree. I'm like, okay, if I don't control this horse, I'm going to come back without a leg. And so you start to learn things very quickly. So the second half, I finally relaxed and the horse started listening and I really enjoyed it. I'm like, thank goodness, because I wanted to enjoy it. I just didn't want to force it. So nevertheless, I think I might start getting back on a horse again.
All righty.
So it was a fun leadership program. Got to meet a lot of people across the country. And and I got to meet the cast from Chosen, the creator, the director, and their whole story of how they created it, and which was incredibly amazing. So we'll talk about that another day, though.
Cool.
We need to start talking about retirement planning. It's not about me; it's about everybody else. Randy, you get me into these whirlwinds of conversation.
You're funny though. I love it. So if there's a picture of Mr. Ed up in Sharice's office, you'll know why. There you go. All right. Well, okay. Let's get into it just a little bit. Just a couple of little throwaways here. The fight to beat inflation apparently is not over. The number ticked up a little bit to 2.6 in October. The Fed's going to meet again in December on the 18th. So that'll be right around Christmas time that we'll talk about that again.
Yes.
And we'll be probably looking at another interest rate pullback. Who knows? We'll see. But the market, holy cow, since President-elect Trump has been named the next guy to go into the White House, the stock market likes the sound of it. This is Stephanie Link, and she's talking about not only this market, but back when the first administration took place, the Trump bump happened back then as well.
We already have a decent economic environment. We're running at about 2.5% in GDP. The consumer continues to spend. You have a lot of cash on the sidelines, $6.4 trillion in money markets. So I think you're going to see a nice rally into the end of the year. Remember, under Trump, his first term, from the eve of the election to mid-March of 2017, the S&P 500 rallied 11%.
All right. So initially, the market was up like 2,000 points in a couple of days, and then has just kind of leveled off a little bit since then. But this is, this is Wall Street saying, hey, we like this guy. He's not about regulation. He's about moving business forward. He's about lower taxes. And the initial feeling on Wall Street is, let's go, and let's go hard. So there you go.
Yeah, it's so funny, Randy, because there's some people out there that aren't feeling good about Trump being elected and some people that are feeling good. Like, for example, Warren Buffett. He has sold a lot of his equities, especially in Apple. He's not majority anymore. And he's got over $300 billion in cash saved. And his take is, you know what? I don't feel, my vibe isn't going the same way as everybody else's maybe, and he's waiting for opportunity. And the thinking is treasuries are going up.
Yep.
And so why not go into a risk-free rate of return that might be offering 5% and just wait for silly-nilly Wall Street to take a tumble, because it can't last forever, whatever day that is. And so that's where he's at. And this is why he's good at what he does, and he's a machine, and his team is. But there are some other people out there that think differently, because the behind-the-scenes noise says there's a recession in the next 12 to 24 months. But I am all gangbusters right now for the market. We do active management here, so we don't have so many worries in the stock market, because we take advantage of movements when it goes up and when it goes down. And we have exit strategies and safe money strategies. We have a very balanced type of portfolio. So that's the good news. And but the consensus is people are coming in my office and they're saying they're excited. They feel more confident about the next 4 years. And so just so everybody knows, taxes might be better for us. So we're excited about that. And so take advantage of these opportunities while we have it, especially in the tax world, and maybe converting IRAs to Roths, because this could be our window of opportunity to make big changes for you and your surviving spouse, and then your heirs when it comes to the tax plan, because after 4 years, taxes could really, do something different where we can't take advantage of the lower marginal tax rates.
So I've heard from you, I've heard from others that a lot of people have kind of put their financial decisions on hold over the last couple of months and said, let's just wait to see how this election turns out. And so now we have a winner. We have our way forward. But some people believe that 2025 might not be the year that we thought it would be, even with all of these good conditions. Are you having to caution anybody and say, hey, calm down. I know it's exciting. But if you try to time the market, I mean, it's literally like people are saying, I waited. Now I'm going to push all in. Well, what if that doesn't work out? Do you have to caution people about taking too much risk?
You know, the stock market is so annoying, Randy. Things happen differently all the time. It's nonsensical. The math doesn't make sense half the time. And hope floats. That's where I'm at right now. Technical indicators, we follow those. And so anybody who's predicting the market is crazy, number one. Let's get that right. I'm not going to predict it. You're not going to predict it. I'm telling my clients, invest. Let's invest. Let's have some fun with it. Leave some in a cash flow realm for our income now. As long as you have your income in something conservative and safe, the income you need for the next 5 to 7 years, then yeah, if you know what you need for the next 7 years, then yeah, you could probably invest the rest with more risk because you don't need that money, right? And the reason why I say the next 7 years, because a lot of things can happen. If the market does take a tumble in 12 to 24 months and then it bottoms out after 18 months and it takes 4 years to recoup, you've got 7 years of income sitting there. You're not going to stress. You're not going to worry. Your financial conventional wisdom, you're going to be like, I've been taught, buy, hold, don't sell when the market goes down. And the only time you sell when the market goes down is when you need income. So just don't have those income dollars in those types of accounts. So that's called being balanced, Randy. And so we have an ultra conservative portfolio in all of our clients' balance sheets. Then we have a moderate, and then we have a mid risk, and then a lot of people have this big risk portfolio with us, and we just know we're not even tapping into that puppy for like 15 years because we don't need those dollars. We've really got the next 5 to 10 year plan. So I'm okay investing because what if the market goes up? You're going to say, woulda, coulda, shoulda. If the market goes down, you're still going to say, woulda, coulda, shoulda. Now, nobody's ever really going to be happy. Yeah. So just invest. Keep some, take advantage of the treasuries. Take advantage of these annuities. Take advantage of these equities. Just be balanced, right? And if you're balanced, you're going to have more confidence. But if you just have yourself in a 60-40 boring old school, I call this a 1980s portfolio, it might not suit you well in retirement.
Well, we would love to have the opportunity to talk through it with you. Give us a call at Zinnia Wealth or look us up on our website and click on the button there. Here's how you do it. ZinniaWealth.com, ZINNIA Wealth.com. There's a gold button there. It says Complimentary Retirement Consultation. If you click on that, we'll ask you to put in a little information, and our team reaches out to you. We'll get a date on a calendar. Or you can bypass all that and just give us a call, 833-368-3680. 833-368-3680. We're going to take a break, and when we come back, two things I want to talk about that are changing or might change. Number one, President Trump said that when he gets in office, he's going to eliminate taxes on Social Security. Could that actually happen? And your 401k. 2025 is bringing up some new rules for you that you need to know about. Those are next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, it's ZinniaWealth.com, ZINNIA Wealth.com. If you're listening and you're kind of into what we're talking about here, and then all of a sudden you got to get out of your car, okay, that's no problem. We have a podcast. You can hear the whole show. You can hear segments of shows. Go to iTunes, go to Spotify, go to your favorite podcast provider, or use our website there under the media tab. You can hear the whole show and that part that you didn't hear. So, let's talk through it. President Trump said during the campaign he wanted to eliminate taxes, federal taxes on Social Security. Everybody was kind of on a thumbs up on that. You wonder, is it going to take place? Well, let me tell you something. There is actually a measure in Congress right now. It's a bill. It's called You Earned It, You Keep It. And
love it.
Yeah, and it would eliminate the federal income tax for retirees on their Social Security. We'll see if it passes, but now we have the Senate and the House all red, so you would think that it probably would. So, Sharice, that could change some retirement planning. What do you say? I mean, does this...
Well, if it changes retirement planning, it would be in the positive direction.
Exactly.
Because most of our clients do pay taxes on their Social Security, and a lot of them say it's like double taxation. I'm like, yeah, but we can't stop it.
Right.
And for years, I've been teaching these workshops, talking about radio and TV. And I said, how nice would it be if Social Security was not taxed in retirement? And I've been saying it enough. Maybe we willed it. We'll see, right? But right now, it's called provisional income formula. Most retirees haven't heard of this. And it's a formula. They take your modified adjusted gross income. So you add in your wages, if you sold a house, capital gains, you got a pension, you have cash rents from your rentals, et cetera. They add that all up, and then they only add half your Social Security check and any tax-exempt interest. So if you have a muni bond, that interest, we know it's lovely, it's tax-free, but they somehow circle back and put that interest into this equation, which is crazy to me. But when you hit this $44,000 number, so if you're married filing jointly and your income, which is easy to do, if you're married filing jointly, is $44,000 or higher, it says up to 85% of your Social Security is now taxable. And not only is it taxable, it is taxable at the highest marginal tax bracket you land in. So it would be fabulous if they did get rid of that. And, or maybe they get rid of it for the short run. So it allows people to roll more IRAs over to Roth and not have to beat the street trying to hit these numbers just right. But, you know, I do worry because Social Security Trust Fund is already having problems, right? So that's the reality of it. And a retiree would rather pay the taxes and do this provisional income formula than have to worry about Social Security running out. And right now in 2033, it's not looking good. It's showing, hey, might be reducing your benefits 20%, right? That's the word on the street.
So I got a quote here that backs up what you say, Charisse, and this is from Garrett Watson of the Tax Foundation. And he says, exempting Social Security benefits from income tax would cost $1.6 trillion over 10 years. It would accelerate the insolvency of Social Security and Medicare and create a new hole in the income tax without a sound policy rationale. So there are people that believe that this could actually hurt. President Trump says we'll get the money from tariffs. We'll get the money from elsewhere. We will see, you know.
It's a big movement, right? And depending who is the next president, if they keep the tariffs intact, I mean, we could be bouncing all over the place.
Yeah.
So the next president after Trump is what I worry about next. That they hold ground to what he puts together, because if they do, then this should pan out. But if we go to this tariff thing and then in 4 years, new president says, squash the tariff thing. I'm like, what a mess. I mean, what aggravation us Americans have to go through. So a lot of changes are going to happen. And no, we cannot predict it. And $1.6 trillion over 10 years is a lot. Plus we're paying over $1 trillion in our interest, right? And our deficit is, I don't know. Well, where are we at? I mean, we're in the negative. We don't have a surplus here.
35 trillion in debt. And I think
38.
38 now. Well, see, there's a counter. I gotta, by the end of the show, it'll be 39. But we are paying, I think we're paying somewhere in the vicinity of $3 billion a day just in interest on the debt. So this is not a good situation.
So, I would be very excited to see what the plan is. How long can we roll with it? Does it make sense? And it's really just finding out what's going to happen with these tariffs. Once we land the plane on the plan for the tariffs, then we'll have certainly some certainty on Social Security. And I am very wishful that retirees don't have to pay taxes on their Social Security. What a amazing blessing.
That'd
right?
be nice.
I truly believe that. And so let's just see what the plan is. Nobody worry. Let's, things take time, and let's not guess or predict. But in the meantime, you still have to worry about this provisional income formula. And that is something we do for our clients when we're doing their tax plans. So when you come in and we do your tax plans, we build that provisional income formula. We show you what you're paying, because those are important steps and know-hows when it comes to, hey, do we roll IRAs to a Roth? Do we do tax loss harvesting for you? How do we do it, and when do we do it?
Well, we would love to have that conversation with you. Income, income, income. That makes the world go round, as Charisse says all the time. And the most important thing that you can come out of this meeting with is, you know what your paycheck is now. Do you know what your paycheck is in retirement? Social Security is part of it. Let's figure it out together, and let's certainly keep track of all the new rules. Here's our number. Here's our website, 833-368-3680. Give Sharice a call or just use our website, zinniawealth.com, ZINNIA wealth.com. Hit the gold box there. It's down in the lower right-hand corner. It says complimentary retirement consultation. Well, you talk about 401ks and Roths, and we actually have some new rules. You probably know that you're over 50 years old, you get to put a little extra in. Everybody gets to put in $23,500, but as a person over the age of 50, you get to put in $31,000. Well, there's a new law on the book for next year. If you are between the ages of 60 and 63, you get an additional catch-up. It's $34,750. So these are the people that walk through your door, Sharice. If they were to look at you and say, should I put that money in my 401k? Or should I put it someplace else? It is possible to have probably too much money in your 401k for taxes. How do you figure that one out?
Yeah, so most people between the ages of 60 and 63, Randy, are in their retirement red zone, I call it. They're about to retire. They got 5 years before they retire. And so what you're doing at this phase of life, this is when we're really working with people saying, hey, let's lower that IRA, that 401k bucket that's been tax deferred this entire time. And let's start rolling it to a Roth IRA for tax-free dollars. And so we're adding more to that problem. So I am a fan of, if they'll allow you to put it into a Roth 401k, please do. That would make more sense, because as soon as we start working together, we're going to go already move those dollars over, most likely, if it makes sense. But some people, Randy, say, well, Sharice, my income is $150,000 or maybe $300,000 a year, and I get that right off of my income, and I can't roll an IRA to Roth now because that just adds to my income. So trust me, it is a pain point, and it's not for everybody. So depending on where you have saved your money, how much income you have, we've got a good probably 5-6 years here to maneuver monies over and have a better tax strategy in retirement if you're in that retirement red zone. So this is why it's very, very important to work with a registered investment advisory firm that is a fiduciary that does tax planning, investment planning, and income planning, so we can really waver between do we or don't we, and what does it cost us? Because I don't expect you to make those decisions, but I will tell you, people sometimes do not make the right decision because they have not come in and seen us do the math. And there's so many people that come in, Randy, that said, oh, you mean I could have done this for the last couple of years? And I'll be like, yeah, what were you waiting for? Oh, well, I thought, I was going to wait to see you once I was getting ready to retire. And gosh, I really wish I would have come and seen you. Listen, don't wish upon a star. Come see us, because this is what we do. We're here for you. And the sooner we get to work with you, the more empowered you're going to be, the more tax-free you might be in the near future. And that is the goal. And it's just not for you. It's not about you. It's about your surviving spouse. And then the double whammy is then it's about your heirs and how are they going to receive your estate? Is it going to be tax-free? Is it going to be taxable? What is it? So having those conversations are so, so important.
Well, in the same way that you could walk in the door and put down all of your portfolio and holdings and things that you have, and she might look at that and say, wow, you've got, a whole bunch of Home Depot. You've got a whole bunch of Coca-Cola. We're a little overvalued or a little too much in this area. The same thing can happen with a 401k. We've got too much money in that tax-infested bucket, and we have to do something about that. That is a conversation that comes out when we do that portfolio x-ray, and it certainly has a lot to do with taxes. Let's take a look at that 401k and figure out how we can make that work for you in retirement. Here's our number, and here's our website, ZinniaWealth.com, ZINNIA Wealth.com, or 833-368-3680. 833-368-3680. Give us a call. Let's get a date on the calendar today. We are going to take a break, and when we come back, baseball season is over. The LA Dodgers won the World Series, and they are doing something financially that we can learn something from, and maybe we could actually do it with our retirement plan. We'll tell you what that is. Coming up next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com. Or to give us a call, 833-368-3680 to sit down and talk about your retirement, how it's all going to work. But right now, I'm starting to get hungry because it's not too far from Thanksgiving.
Gobble.
Yes, indeed. And now I've been in your kitchen. You go to it over there. You've got a pretty nice kitchen. And so tell me, what is it all about at your place? Is it turkey and potatoes and then all the sides? And I'm interested what the sides are that you really like.
It's complete chaos in my house. I love it. So this is the first year we are having the entire family at the same time. Like I love being around my family, and more kids, the better. I want my house to be completely trashed, and I want kids running in and out of the backyard. I don't care. Bring your dogs. I thoroughly look forward to Thanksgiving because that's the one time we all try to really get together. So it's interesting because the night before we're at my house and we're doing like an Italian thing, and then the kids do their show and tell or show their talents, and it's just a fun time for us. But then everybody goes home, and then my sister and we start cooking that night, and we'll stay up. We do this all the time. I so look forward to this, where we just bake and we cook, and we're up to 1 o'clock in the morning. And so getting ready for the next day. And then we wake up, we have our coffee. Some people go for a jog. I don't. And we just have our morning coffee talk. And then we really start the cooking. And so I love Thanksgiving, and I know a lot of people do out there as well. But I got to, I know I got to circle this back to, retirement planning here. But I am not in charge of the meat and potatoes, right?
All right.
The dudes are in charge of the meat and potatoes. So let's circle this back. Randy and I are talking meat and potatoes. That's like, we need the meat and potatoes, right? The meat is good for the gut check.
Main course.
The probiotic. Yeah, the main course. That's in retirement, in my opinion, income.
Okay.
That's the income that you need to survive, right?
Yes.
If anything, have that protein. And then, the casseroles. Everybody, all the ladies start to bring different casseroles. And so I call the casseroles like the treasury department in my house, because that gives us a little extra cash, safe money to live on. And we got to have the casseroles. You better have that green bean casserole, right?
Got to be there.
Cornbread casserole. That's my favorite. That's one I do. So we have different pieces that come into the play, but then we got to have the peach cobbler, and the peach cobbler is and the pecan pie. That's the equity stock market. That's the excitement.
That's the sweet
where
stuff.
the sparkle in our eye takes place. Like my family, we love sugar. We start talking about sugar, you're like, who are you, Cookie Monsters? Like all of us are like that. And so we got to have the equities, that pie in our portfolio, and then we got to have the boring stuff. So the RMD world, right? You're forced to take these dollars out of your IRAs, and let's just call those the beets. Okay, we're gonna take the beet, and you got to have the beet. It's good for your heart. If you don't have the beets, people are looking. You got to eat the beets. You got to eat the beets, right?
No.
And so you got to take those RMDs out of your IRAs and pay the taxes. So on my plate, I do eat the beets. For some reason, I just feel like I can eat the beets. I do.
All right, let me ask you, what's your opinion on cranberries? Because cranberries, everybody needs about a quarter size of cranberries, and that's all they need. But it comes in this great big can, and you open it up and you turn it upside down. And it goes plop.
Is that even healthy? Is there anything healthy about that? No. I think we nixed the canned cranberries.
Yay!
Okay, but I will be honest with you. I do like cranberries, full disclosure, so I always get a little bit. But I need somebody to make me homemade, real natural, good cranberry fixings. Right. Anybody out there?
Oh, my gosh.
So, yeah, that's that's the thing. That's that one little small ingredient, that you just kind of dip your food in or you eat it. And, I would say 9 out of 10 people have the cranberries. So how do we circle that back to retirement? How does cranberries fit in? I don't have a plan for that one, Randy.
I think cranberries are Bitcoin. Bitcoin this. It's risky. It's you don't really need it. You only need it if you want it.
Hey, I got a Bitcoin portfolio that I like for my clients, so let's not razz too much.
Okay. All right.
But I do push people away from it if possible.
Well,
but yeah, cranberries.
We hope that you enjoy your Thanksgiving,
Yes.
and we would love to put together your retirement plate for you here at Zinnia Wealth.
Yeah.
Give us a call, 833-368-3680. All right, so I mentioned the Dodgers won the World Series, and of course, after they, say, where's the parade? The next question is, can you do it again? That's what, will you let me celebrate for just a minute before you ask me, can we do it again? The Dodgers actually have a unique situation. A number of their star players, like a half a dozen, have deferred millions of their contracts for years to come, even after they're done playing. So the Dodgers are on the hook for these contracts for years and years, probably 20, 30 years they're going to be playing. But in the meantime, it really does help them build the team. So with that word deferred, Charisse, you have talked about this in the past, that there are people that walk through your doors and they have a business. Right. And, they've been making, whatever they've been making all these years. It's been able to, power what they do in their life. But now they want to sell their business. And all of a sudden, Uncle Sam looks at them as a millionaire. You just sold your business for $5 million, and now you owe the taxes on that. They take a massive hit in 1 year. Is it possible, like these baseball players, to defer, not the salary, but defer the taxes for later in life and spread this out a little bit?
Oh, yes. And I'm going to tell you. So I just did one the other day and had to get the trust attorneys and the accountants, everybody involved. And they won a suit against a big retail firm.
So a big windfall. Okay.
A big windfall. They were expecting $12 million. I think they got just a little over $5 million.
Okay.
And we did the math on it. And sometimes when you win these lawsuits, depending on what it was about, if it's commission driven or whatnot, it's either taxed at capital gains or ordinary income rates. Okay. So most of the people we do this with, it's based on capital gains rates, which is typically lower than ordinary income rates. It always has been.
Right.
And so this person, it was one of my first. It's like, oh no, this is ordinary income rates. I'm like, oh shucks, this makes more sense than it ever did before.
Yeah, big tax bill. Yeah.
To be able to keep all of that money, we have to put it into a tax strategy. I don't want to give up what the tax strategy is, but it's beautiful. It's a wonderful option. I don't know any advisors that do it in the surrounding areas, but I just felt like it was something that was needed for clients and their friends and family that were selling big commercial buildings. If you're about to write a $400,000 to $500,000 check to the IRS, don't come see us. We'll talk to you about how that works, because you can still put these dollars into any kind of investment you want. You just don't have to pay Uncle Sam now. And, you keep it for, so many years. But you do have to take income from it eventually. Like they usually give you like a 3-year time period. And this is, okay, now you got to pull like 4 or 5 or 6% from it, and based on rate of return. And it's a great option. And after so many years, you can do it again. You can walk away from it. Of course, when you walk away from it, that's when you pay your taxes. And it's just a really great option out there. Doctors who are selling their businesses, any kind of non-injury lawsuit this makes sense for, and so much more. So we have gotten a lot of calls, and people are happy to know that there's somebody locally that's doing this, because they can have the face-to-face. They can work with somebody instead of driving to Orlando or driving to Tampa, et cetera. So it's a nice option.
Well, if you're selling the family farm, selling the family business, if you come into a lot of money, if there's a large piece of property and you said, this is going to power my retirement, and then you sell it and like, holy cow, look at the taxes. This is a time for sure to sit down and talk to Charisse. Give us a call. Give us a look on our website, ZinniaWealth.com, ZINNIA Wealth.com, ZinniaWealth.com. Hit the box that says complimentary retirement consultation. You'll be on your way, or just call us, 833-368-3680. All right, so I'm going to take 2 stories here that we have done in the past, put them together, and ask you a new question. Here we go. We did a story not that long ago where they interviewed people who are in retirement. They're in their 70s. They're in retirement. They said, what's your biggest regret about going into retirement? And they said, I should have retired earlier. I'm really enjoying this. I should have done this, pulled the trigger on this earlier. Now, story number 2. If you ask people who retire really early, like before the age of 62, many of them will say there's a lot of stress in their life, almost as much as work, because the finances have to be spread out and last even longer. So there's a stress factor there too. So Charisse, there's this tug and this pull. I should have retired early, but if I retire early, it brings up a whole bunch of different new things. How do you decide? How do you do the math on when a person should retire, an age, a year? How do you do it?
Well, first of all, I learn very quickly who the person is when they come in on the first appointment, and all of our advisors are trained to do the same thing, and really see if retiring would drive them crazy, because some people just have this tick that they love working, but there needs to be a work-life balance. I haven't figured that part out. But if they were to retire, it could really hurt them, right? Okay. And so if they retire, what are they going to retire to? So having that conversation, what are you going to do next? Because you're a dude or you're a female that calling it quits, I think you're going to have remorse. So let's talk about the next phase, that encore career. What are you going to do realistically? And it could be a job, could be volunteering, but something to keep you going and excited about life, right? So we start with that and get to know the client. And then what we do is we do a check on emotions. And because retiring is emotional, Randy, it is psychological. Mm-hmm. And how important it is for that person to get the attaboys or feel that people coming to them and knowing that they're helping as a gauge. Is that going to be critical when they leave retirement? So there are actually it's a neurological thing that happens with people, and knowing where they're going to stand so we can prep them for you, this is what's likely going to happen with you. And so let's make sure we're doing this right, because I don't in 3 months or 6 months want you to be like, oh, why did I do this? I didn't retire just to do honey-do lists, right? And then we got to check the pocketbook, right? That's like, all right, now we got the mental, we got the psychological, we got the next plan. Do you have enough to retire? And if you pass away early, does your spouse have enough to retire and stay retired, right? We want to stay retired. And so then we start taking inventory. We look to see if their debts are paid off, houses, credit cards, cars. Do we need a new roof? Do we need a new car? What is the plan? And then we check the income statement. What are the fixed things that are coming in? Is Social Security checks coming in? When are they going to come in? We create a plan for that. Do you get a pension? No, you don't get a pension. Would you like a pension? We can create one. How much do you like at risk? Do you want nothing at risk? You want it all at risk? And then we start to create the bucket list, and then we start to figure out how much extra can we spend after we figure out what we need to spend to pay the gas at the pump, the grocery bill at the store, and that light bill. Make sure those things are fixed, certain, and can always be paid. Now, how much are we going to spend on travel? Are you somebody that's going to spend $5,000 on travel, $10,000, $40,000? I had a client that spends $70,000 a year for the next 10 years during their go-go years on travel. So where are you? And if you're not going to travel, what are you going to do? And are we going to gift? So there's so many elements that go into this planning phase, and we're not going to hit it all in 3 appointments, but we cross the bridge here, and we put that bridge between that gap and really try to figure out where are you at. And so we do that with our income planning software. And the income planning software, Randy, is the cat's meow. It is the cat's meow. People love our income planning software that we use because we make it easy to understand. So nothing here is complex. Everything's explainable, and we do it in such a simple fashion. And people appreciate that. So really finding out, doing the math, inventory, liabilities, fixed incomes, where are we going to spend our money? Are we going to go on 5 cruises a year for the next 10 years? Because I truly believe that the first 10 years when you retire, I don't care if you're 55, 60, I don't care if you're 70 and you're retiring, the next 10 years is going to be the healthiest 10 years of your life. So take advantage of it so you don't have regret later.
Well, what it all sounds like to me is it's a great conversation. There's a lot of listening and there's a lot of figuring. And just figure out what you want to do in retirement, and let's put the money with it. And let's figure out the date that works for you. And then sometimes, that we can say, okay, you can retire. Here's the date. And then you go, well, you know what? Maybe one more year at work. And that might work for me too. So give us a call, give us a look. It is all about the meeting. 833-368-3680, 833-368-3680. Let's get the conversation going. You can use our website as well, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says complimentary retirement consultation. Just click on that and you'll be on your way. Well, we've talked a lot about politics over the last couple of months because that has just dominated all the news cycle. Well, in the financial world, they talked to Republicans and Democrats to see if they agreed on retirement. There's 4 things that they agree on, and we'll tell you what they are. Coming up next on Retirement Coffee Talk. Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, it's ZinniaWealth.com. Hey, when you go to the website, there's so much there to explore. ZINNIA Wealth.com. You can go to the navigation bar up there. There's something there that says education. If you click on that, there's useful guides. There's a lot to explore there. There's also our podcast. If you're listening to the show and you got to go, that's okay. You can listen at your own leisure whenever you want, and you can find it right on our website under the media tab, or you can use Spotify or iTunes as well. All right, so Sharice, Republicans and Democrats were asked about a financial study from the Greenwald research people, and both parties agree that there is a retirement crisis. And when they were asked, here were the 4 biggest issues that they agreed on. Number 1, too much debt. Number 2, inflation. Number 3, uncertainty about Social Security. And number 4, the lack of a pension or guaranteed income. Those are the 4 things that everybody agrees on that are really hard about retirement. So that's where we come to you. So let's check them off one at a time here. Number 1 is too much debt. When you talk to somebody sometimes early, this is really the first part of attack is to get rid of that debt, isn't it?
Yes. So getting rid of the debt is key. Like, do not enter retirement with credit card debt, right? I get it if you have a car payment, your plan is to pay it off for the next couple of years. I can handle that. Mortgage interest, you can't write it off if you're taking standard deductions. I always advise pay off the mortgage if you can. Mm-hmm. But if you're itemizing, then I'm going to tell you something different, right? Because you need that write-off. But I will tell you, I paying off your mortgage. Mr. Pillow, sleep better at night, I suppose, if I can legally, compliance-wise say that on radio. There's something about that these households out there, both spouses agree to this too. And they say, if something happens to me, I want to make sure my spouse is not stuck with the mortgage. Mm-hmm. And this is why people pay off that debt, because we know when somebody passes, income goes down because we lose the Social Security check. So, making sure you're doing the right thing at the right season of life and the right time of your life. If you're getting ready to retire in 10 years or 5 years, or maybe you're retired, this is a conversation I love having with people, because there's advisors out there that says, don't pay off your debt, or don't pay off the house because it's only a 3 or 4% interest rate. Mm-hmm. And I get the math behind that. And yes, but there's something else to it as well. So we'll have those personal conversations, but having less debt in retirement is always a better scenario.
Even if your payment is a 3 or 4% payment, but if it's $1,000 a month, imagine what that $1,000 could do for you if you wanted to use it for travel. So just think about that. All right. Number 2 is inflation. And this kind of actually goes along with the income portion of this, is that, the price of things is going up. It has been forever. I mean, it went up a lot over the last couple of years, but it has been forever. We really do need to be ready for that. So if you think you can do retirement on $6,000 or $7,000 or $8,000 a month, in 5 years, that number's got to go up, doesn't it, Sharice?
It does. So when we build out the income plans, we make sure that you have an inflation adjustable income plan. That means every year, we'll set the rules however you like it to be, but we want to at least put a 3% increase every year. A lot of people can't see that on paper. They can't visualize that $10,000 today might be equivalent to $15,000 in 10 years, depending on inflation. But I mean, look at what just happened over the last couple of years, Randy. Inflation, we've gone up over 20%, and we're stuck with that 20%. Nothing's coming down. Yeah. Nobody's going to give you a better deal because this is just where we're at. Inflation will will hopefully stay at that 3%, 2.5%, 3.5% for the remaining time period, but we never get rid of what it went up to. That's the unfortunate part. So I hope a lot of people did plan for that. We have clients coming in and seeing us. We are readjusting their income now because of that, which is always in the plan anyways, which was the good news. But, don't live on less because you're scared of running out of money because you didn't have that inflation adjustable plan. So that is killer to people's portfolios and to people's plans. So make sure you understand that fully.
Yeah, for years and years, Sharice and I have been doing this show for 11 years now. And, for years, inflation was stuck right around 2%, 1.5%. And we didn't really talk too much about that. But then all of a sudden, it became a huge talking point. So as these things become huge talking points in your retirement, you're going to have somebody to talk them through. And Sharice is that person. Give us a look on our website, zinniawealth.com. All right, talking through more our list, and this does, again, go to income planning, and that is people are uncertain about Social Security. We've already talked about how the Social Security Administration says in 2033 we're going to probably have to cut back benefits. We'll see. But, Sharice, if somebody's going to get $3,000 now, but they're going to get $2,500, in 5 years or 10 years, that's a hit, and we got to make up for that, don't we?
We do. And the whole Social Security system needs to be changed a little bit. For some reason, everybody tippy toes around changing dates of full retirement age, but the earliest you can collect is 62. Full retirement age is somewhere between 66 and 67, and you can delay all the way to 70, and you get a delayed retirement credit that averages somewhere around 8%, right? But here's the problem. Massive changes have to happen there. If you're 50, you shouldn't be collecting full retirement age to age 67 because you're going to live to 90, right? That's the expectation. If you're 40, your full retirement age shouldn't be till 72 or 73 now, because you're going to live to 95. That's the expectation. People are living longer. So the Social Security Trust Fund cannot afford to keep doing this, right? And so big changes will have to happen. But the younger people, this is just, we work longer, we're healthier than ever. This is just expected, right? We're not, your grandfather's retirement and your mom and dad's retirement isn't going to be our retirement. I'm in that 40 to 50 range, right? So I get it. It has to happen because if I want any of it, it has to happen. So I understand that. So that just means I delay a little bit longer. And so the sooner people come to realize this is what we have to do, and let's dig deep, let's do the data, and let's just get this done and move forward, the better off we're going to be. So Social Security, there are a lot of uncertainties, especially for Gen Xers or Xennials, and certainly millennials, right? So how do we make it more certain for them? We make catastrophic changes now, and we just suck it up and move forward. But the baby boomers, we can't make changes to them. They need to collect when they're supposed to collect. They have their rules that they've been paying attention to for the last 30 to 40 years of their lives. So let them set sail. Let them feel confident about Social Security so they don't have to worry about that check going down or losing it totally. So the younger generation has to step up.
It's a huge part of the income discussion, and that's job number one for Sharice and for you as we work on that complimentary retirement consultation and plan. And the last thing on the list goes right along with that. Pensions have gone away. Income has to be there, and even if you don't have a pension, we can build you a pension, a personal pension, out of your 401k, out of what you've saved. And having income coming in is better than peeling money off the top of a 401k, isn't it?
Yeah, so let's make sure your fixed items that you're paying for on the daily are covered. So a lot of times people's Social Security checks are just enough to pay the gas bill, the light bill, the food bill, right? The tax bill. But some people need a little bit more. So if you have $1 million portfolio, there's absolutely nothing wrong with taking $150,000 to $250,000, that $1 million portfolio, and creating a pension with it, just to make sure things are buttoned up. And also, like, it's an extra backup if one spouse passes away, that pension check goes to your surviving spouse. So it doesn't derail the retirement plan as deeply as just having it all in the stock market, right? So if you have enough built in income, I mean, just think about, I remember when I interviewed Steve Spurrier, he's like, yeah, I have this income check and this income check, and I have this annuity and have that annuity. And he said, and he was just so excited about his income checks. And he went, Sharice, as long as I get my checks, I'm a happy retiree, right? And then he also now has a restaurant, which is amazing. We were just having stories about that. So making sure, and some people, Randy, don't need those extra income check. So when you come in and we take the inventory and we learn about you, I will say 1 out of 10 people need that extra income check when they come in and see me personally.
Well, we would love to have that opportunity to run that math for you. And if you are worried about what do I ask a financial advisor? Well, here's your question. What is my retirement paycheck? Figure that out, and a lot of things start to calm down. Give us a look on our website, ZinniaWealth.com, ZINNIA Wealth.com. Click the gold box that says Complimentary Retirement Consultation, or give us a call, 833-368-3680. Sharice, that is all the time we have on this one. I'll give you the last word.
What a great week. What a great week. Weather is beautiful. Thanksgiving is upon us. Gobble, gobble. Thank you all for tuning in. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.